Welcome guys to the Charter Quest CFO Global Competition. It is episode 2 of a series of 7 episodes. If I can just take you back to the first episode, what did we do? The first thing is I introduced you to the co-founders. Those were my guests on that episode, the co-founders of this competition. And what we spoke about there is how this competition works and the 4 stages of this competition. The other thing we spoke about, we introduced you to the judges, which is a key thing in this competition, the high caliber of judges. Now, what are we going to do in episode 2? Episode 2 is we're going to speak about the semi-finals. If you remember, go back again to episode 1, we spoke about how all these candidates from all over the world on the global competition enter, and the judges choose the top 6 teams to come to South Africa. And what happens in that semi-finals, that is actually what we're going to speak about in this episode. Usually when we introduce these teams, we introduce them in alphabetical order. It's just how we introduce the teams. So what I'm going to do is 3 of the co-founders are my guests today in this episode, and each of them are going to introduce 3 of the semi-final teams of 2016. They will speak about those teams. In the next episode, we'll do the next 3 so you guys understand the top 6 semi-final teams. So what I want to start first is with my first guest, which is Patience, if she can just speak about the first team.
Thank you, Johnny. The first team to present was Team Ale Consulting from Australia. They made 5 key recommendations to the board. 1. Negotiate with the government in Nigeria. Number 2. Enter China by acquiring a smaller operator rather than CloudNet. And 3. Proceed with the SSC in South Africa but scale down. Number 4. Sell off to Turkish operator and walk away from Iran. And 5, raise capital through an accelerated book build. Let's take a look.
Okay, ladies and gentlemen of the board of MCOM, good morning. My name is James and these are my colleagues Victor and Hugh. We're from Ale Consulting and we're here to talk about the urgent issues that MCOM is currently facing. Before we get into those issues, let's take a quick look at your current situation. Now, you've had a lot of bad news lately. The sanctions against Alania, the fine in Nicolia, and backlash against your cost-cutting measures in Sedimba. We've had to make some adjustments to your 2015 financial statements and your 2016 forecasts, and they're included in the appendices for your reference. But what this ultimately means for MCOM is that you could soon be facing insolvency and you soon may be over-leveraged. It is a concerning trajectory. So what do you have to do? Well, we're going to take you through, firstly, how to address the urgent short-term issues. We'll then take you through our recommended approach for raising capital. And finally, we'll talk to you about how you can stay ahead of your competitors. We're confident that our recommendations will effectuate a new course for MCOM, taking into account ethics and the interests of all your stakeholders. So let's get right into it. Victor?
Thank you, James. The highest priority issue to be addressed by the board is the current situation in Alania. Currently, there is high strategic uncertainty and political risk, considering that there may be long-term sanctions being placed upon MCOM from the Alanian government. Based upon MCOM's interests and financial priorities, based on your revised risk appetite, we've analysed all your potential courses of actions. Firstly, considering that the government is likely to nationalise all private companies, there's a high chance you may lose your current stake in JV Cellular. Secondly, there have also been concerns that the JV Cellular is aiding the Alanian government in an unethical manner. Given these 2 important factors, MCOM must exit Nicolia now. And you can do this by selling off your stake, and there are 2 interested bidders. 1, a Turkish mobile operator is willing to give you their equity, or 2, an Indian cell phone group is willing to give you cash. Ale Consulting recommends selling to the Turkish mobile operator for 3 key reasons. Number 1, financial payoff is much higher with the Turkish mobile operator. Number 2, the cash you would receive from Latini is also dependent upon sanctions being lifted in Alania. And number 3, by undertaking the Turkish mobile operator swap, this will ensure that MCOM can continue to maintain its exposure in the Middle Eastern telecommunications market. Now, we understand that there is currently lack of information in regard to the Turkish mobile operator, and so MCOM must conduct due diligence now in order to gain the appropriate amount of information. In particular, it's important that you review the financial statements, you evaluate the liquidity and volatility of this Turkish equity, and you also assess the operating environment in Turkey. Based on that, if due diligence is successful, you should accept the offer from the Turkish mobile operator. However, if it was to fail, then you should accept Bitini's offer. Ultimately though, at the end of this, MCOM will have completely exited Alania. The next issue to be addressed is the $58 billion fine that has been levied against MCOM by the Colin government as a result of MCOM not removing unregistered users off their phone network. And we have valued MCOM's current equity valuation between 67 and 76 billion Sidimban dollars based on a DCF model. Now, paying off the whole fine would still leave residual value in Nicolia, and hence MCOM should not consider leaving Nicolia just to avoid paying the fine. That being said though, paying this fine should be done if only it is absolutely necessary to continue operating, as it does wipe out 80% of the current valuation. I Consulting recommends that MCOM must continue to negotiate with the Colin government now to continue to lower the size of that fine. Now, we understand that this does sound like a tough challenge. There has been much backlash from the Nicolian public from the actions that MCOM have taken so far. And that's why we recommend that you offer them a solution to the underlying problem, and that is how to neutralize the Blancana terrorists. And we have 3 key means you can do this by. Number 1, you should implement stricter than necessary Know Your Customer or KYC processes to help convict criminals who are conducting activities on your phone network. Number 2, you should assist the law enforcement officers by providing information about these unregistered users, contingent on legal advice. And number 3, you should invest in a national biometric identification system in Nicolia, similar to those that are currently operating in Singapore and China. By doing this, MCOM will be seen as assisting the Nicolian government in capturing those criminals, preventing future attacks as well, and most importantly, protecting Nicolia's national security. In order to achieve this, MCOM must first remove all those unregistered SIM cards off their network. And then they should implement standard KYC processes, because finally, this should help establish a sense of goodwill and good faith between MCOM and the Nicolian government, and MCOM will be well positioned to continue to negotiate a reduction in the size of that fine. The next short-term issue to be addressed is the Shared Services Centre, or the SSC, in Sidimba. Now currently, customers are threatened to boycott all of MCOM's products as a result of jobs being shifted from their domestic market to the Sidimban SSC. Now, while your investors are really happy with all those cost savings as shown here, there has been concern from your employees who are worried, and citizen rights organisations have called out MCOM for abandoning its employees altogether. We have assessed your potential courses of actions and concluded that increasing the SSC positions may actually intensify the public outcry with MCOM. This could threaten future revenues, and may, if the backlash was to occur. Also, the additional cost savings are also extremely marginal. However, if you were to choose to say go back and reduce all the SSC positions down to 0, this would completely eliminate those current cost savings. Not to mention you may incur additional costs such as to transition back those jobs to their domestic market. That's why we believe that you should maintain the status quo and keep the current SSC positions. That's because you will maintain the current cost savings that you have, and the risk of a public outlash is less than if you were to increase it. In order to do this though, you need a strategy. And so MCOM must immediately communicate this decision not to expand the SSC, but to keep it as it is to assuage the vocal minority who are against the expansion. You must then move to reassure your current staff of their job security, because that's extremely important. And so that may help lower their discontent and also the turnover currently being experienced. And finally, you should further optimize the current SSC so you can potentially realize further cost savings in the future. Finally, in March, when you have your AGM, you should also provide a cost-saving breakdown as requested by your shareholders, and that can be found in our appendices. Hugh?
Thank you, Victor. So we've prepared a package of strategies to minimize the risk of MCOM becoming insolvent. However, over the next 12 months, MCOM will still be in a precarious situation. If there are consumer boycotts and the Nicolian government demands full payment of the $58 billion fine, MCOM will be insolvent. To prevent insolvency, MCOM needs to raise $30 billion of capital now. We recommend raising $10 billion of equity through an accelerated book build and $20 billion of debt through an unsecured line of credit. This will ensure that MCOM stays solvent until the end of this year. That is when MCOM should shift its focus from these short-term issues to focusing on maintaining its #1 position in the African telco market. We have analysed a number of current macroeconomic trends and have formulated a growth strategy to help MCOM stay ahead. Let's take a look. Firstly, we recommend that MCOM pursue an asset-light operating model by spinning off its fixed assets into a new entity. Secondly, we recommend that MCOM continue to adjust its products to match the changing demands of its consumers. Finally, we recommend that MCOM continue to focus on its core market, Africa, while evaluating emerging opportunities in Asia. First, the asset spin-off. MCOM and its investors are currently exposed to sovereign risk, government fines, and equity market volatility. This is driving a high cost of capital. MCOM can unlock significant shareholder value by spinning off its fixed assets into a new entity, AssetCo. AssetCo will only be composed of stable fixed assets, driving a much lower cost of capital. Ultimately, this will make MCOM leaner and more agile, helping it adapt rapidly to changing consumer demands. Now, this is a very exciting time to be in the telecommunications sector. Around every 8 years, a new generation of transmission technology emerges, from 2G to 3G and from 3G to 4G. As new technologies emerge, the game of maintaining existing and winning new market share has always been about increasing coverage, increasing bandwidth, and increasing data speeds. This is driven by a constant cycle of building and upgrading infrastructure. This is, however, very capital intensive. AssetCo can raise capital at a much lower cost compared to MCOM. This can be seen in this historical chart, where tower operators, like our proposed AssetCo, have traded at much higher multiples compared to telecom companies like MCOM. Hence, AssetCo should make this investment in new infrastructure and lease back this infrastructure to MCOM. Ultimately, this transaction will increase MCOM's earnings per share. Finally, we turn to the question of where MCOM should focus its growth geographically. We found that growth will be the highest in sub-Saharan Africa and the Asia-Pacific region. Furthermore, the high population in these two continents are currently being underserved by existing telcos. Hence, MCOM should continue to focus on its core market, Africa, while evaluating emerging opportunities in the Asia-Pacific region. James?
Thanks, Hugh. One of these emerging opportunities in the Asia-Pacific is to invest in Chinisia. We assessed the strategy of entering Chinisia as a wholly foreign-owned subsidiary, and our analysis found that an MCOM subsidiary would face significant barriers to entry, whereas the market incumbents such as CloudNet and C-Mobile are already several steps ahead. MCOM does not know this Chinesian market. They've never before entered a non-African market without the help of a local joint venture partner. Cost synergies are negligible, and in any case, we know that there's a higher chance that local bidders will be treated favourably in the granting of operating licences. So we don't think that organic market entry is a good idea. This option should be ruled out. Now, come 2018, the licences of the top 4 players in the market will expire. And there's an 85% chance, based on historical data, that at least one of these 4 licences will not be renewed. Millions of subscribers will be looking to switch to a new carrier, and this is C-Mobile's opportunity to acquire customers from the premium segment. But those customers are premium customers, and C-Mobile currently services the budget end of the market. In order to service the very big and very lucrative premium segment, they're going to have to reposition themselves, and they can't do that alone. This is where MCOM comes into the picture. C-Mobile needs to invest in marketing and lease 3G towers. Both of those require capital. MCOM can make the capital investment that C-Mobile needs. So, the preferred approach for entering Chinese. Approach C-Mobile with an offer of equity funding to support their growth. C-Mobile wins, MCOM wins. It is a win-win strategy. As per your brief, we also considered the option of buying into CloudNet. Unlike with C-Mobile, you already have an offer on the table. Although the offer price is at a discount to intrinsic value, there are no supporting financials. So this is a risky investment. You do need to allow time to conduct due diligence into CloudNet. So what do you need to do? You want to enter Chinese working either with C-Mobile or CloudNet. Indicate your interest to both companies early on. And later, you can start working through the details, including compliance with license conditions with either C-Mobile or CloudNet. So, let's recap. Today, MCOM is on a dangerous course towards potential insolvency. We've presented 4 strategies that will help get MCOM back on track. Firstly, raise debt and equity capital. Secondly, exit Alania and start by conducting due diligence into the Turkish mobile operator. Thirdly, in relation to the Napoleon fine, use your position to assist the government in dealing with the underlying security crisis. And fourthly, in Sedimba, keep the shared services centre at the size that it is today. Once MCOM is back on track, then you can focus on maintaining your leading position in the telecommunications sector. We now invite questions from the board.
Thank you, LAS Consulting. A very concise and well communicated proposal. Thank you very much for that. I just have 2 questions, one generic and more strategic related, and 2 slightly technical. So I can share with you both of them, and then you can think about which to answer first. Essentially, in terms of timing, I'm a little bit lost on. You're proposing a lot here, and it seems like it solves world peace for us, at least, okay? Which is great, so you have the answers here. I'm finding it as a board very overwhelming to be in the position that we are in anyway at the moment. So what you are proposing is a number of big ticket items in a number of multiple geographies, which adds complexity and uncertainty, of course, okay? So in terms of risk management, what do you feel is the critical success factors to enabling this execution of your recommendations? And what would be the pitfalls, so what not to do? Because all we can see right now is that fine looming. Our market cap declining, our share price declining, our credit risk going up. So, we're just already nervous about talking to banks anyway. So, forget starting up another entity in another country that we actually don't operate in. So, just your comments on that strategically, please. And then the other one, which is, a minor point on the asset co. It looks great on paper. It sounds to me a little bit like we're shifting the problem and then charging out back to the interco. What are the transfer pricing considerations here? Because I know there's some IFRS in this world around transfer pricing, and all we're doing is moving the problem out and then charging back anyway, back to the group. It just sounds like, from a governance perspective, we don't want to do anything dodge.
So in terms of spinning off fixed assets into a new entity, that's something that's already been quite precedented in the telecommunications sector. And so what we're really proposing isn't some sort of shifting of items between new entities that are being created underneath MCOM. What we're proposing is a new entity, and that new entity can raise new capital, invest in new infrastructure to lease back to telcos like MCOM. Furthermore, given that infrastructure is quite expensive, one of the other things that existing players do in this market is to lease back this infrastructure to other telco players in the market, ultimately increasing the return on that capital invested. From a transfer pricing perspective, generally it's arm's length transactions. And given that there's a lot of precedent of those particular transactions already in the marketplace, that should be something that should be quite achievable to be compliant with legislation.
If that answers the second question, maybe I'll speak to the first. So these are some very big recommendations that we've proposed. And the reason that we've put them all on the table, and it is quite overwhelming, there's a lot to do, is because of the seriousness of the current situation. There are lots of different things that are going on around the world, in different subsidiaries, in different markets, in different geographies. And what we've presented is an integrated package of solutions. We think they all need to be addressed at some point. We've prioritised the ones that are most urgent at this point, namely the Iranian joint venture. It's very important that that issue is dealt with. The fine, obviously, very, very important at this point in time. And also the shared services centre. And what underlies all three of those major urgent issues is that they also affect your public image. So when you can put together an integrated package of solutions that address all three of those, it does give the confidence back to the public and also to your investors. Once those issues are dealt with, other things become easier, such as raising capital, approaching banks, and raising equity capital. So the reason that we've put it through the timeline that we've given for our solutions is to start putting all of these problems on the table, start talking about them and get them sorted. And it does align with your new risk profile and risk appetite, and the details of those are included in the appendices.
All right, thank you very much. You've made suggestions in terms of suggested capital structure. Will you share with the board briefly what are the underlying philosophy that inform the choice of that capital structure? Secondly, given that change, it's something that at operational level, might be difficult to implement. What strategy will you ensure to take the people of the organization along in implementing the suggested strategy? Thank you.
Thank you. So perhaps, another question.
I just want to add to Prof's question around the capital. You recommend a third to be raised on from equity. So I'm assuming you are recommending that it should list on the Nigerian Stock Exchange as the government wants. And you also say 2/3 should be raised through an unsecured line of credit. Am I right to also think that that should also be in Nakolia or is it in Zanzibar? And whichever place it will be, why unsecured, and what makes you confident that we will be able to get a huge line of credit as such to be unsecured?
Okay.
Thank you.
The first part and the second part.
Sure. So that's a very important question in terms of the capital structure of the company. So I'll just go back to the slide where we discussed this. So firstly, raising equity capital is quite important because if you raise all of it through debt, then the company will become quite over-leveraged. And so when we're talking about raising equity, our recommendation is to raise it through MCOM and not to list on the Nigerian Stock Exchange. The reason why we're suggesting an accelerated book build is because currently MCOM is experiencing a lot of volatility on the capital markets. And so the accelerated book build is done over a single night, so it reduces the risk of further diluting the shareholders and shareholders selling up their stock. So that's why we're recommending the accelerated book build. In terms of unsecured line of credit, there are a few options here. You can raise either secured debt or unsecured debt. The problem is that MCOM is currently reaching its limit of having secured debt. There just is not enough fixed assets to raise all of that capital. And so that's why the debt has to be unsecured. Given that unsecured debt usually is a bit of a higher cost than secured debt, but that's something that we can't really do because there's just not enough fixed assets. So there are a couple of things that, in terms of raising this capital, we think that raising around 15 to 19% is a possible interest rate. In terms of, it's still quite high given this 15 to 90% interest rate. And so the other part of the strategy that we're recommending is really spinning off your fixed assets into a new entity, ASICO. And ASICO can borrow at a much lower rate. Based on current yields are around 4 to 5% in the market, and that's really going to lower the cost of capital for MCOM. Does that answer your question?
Thank you. And going back to the operational comment as well, and going back to our key recommendations, I think what we're really trying to understand is that this is about your clients, which are your mobile operators and the people that you do business with. And like we've mentioned, and a bit about the risk management processes as well, it all starts making sure that your customers are happy. And so all the measures that we've implemented now are to address the issues of, say, compliance, that negative perception as well. Operationally, it's extremely important that your staff are on board. And that's one of the key reasons why we think Sedimba can actually be a real benefit to your company, because if you train your staff properly, and ultimately it's about service in the telecommunications industry. Your customers want a great service, they want to make sure that they're part of a great company as well. And so if you train your staff and give them that benefit, and by having all this additional capital, this can ultimately help your business grow and invest, not only in, say, the infrastructure, which we're suggesting, but also in the staff and that whole training process as well. And so that's how we want to manage it operationally.
Just a question. I'm surprised that you would motivate to look at C-Mobile. Just your thinking around that. Because in the mobile environment, the most critical thing is brand. And to take brand, it takes years to build brand on the one side, and to move from low ARPUs to higher margin ARPUs is quite difficult. Just share your thinking, your strategic thinking around it.
I'll start off. So I think first and foremost, we understand that MCOM has a great brand in Africa, but before all these situations have started to occur, but still they are obviously the market leader. And so by leveraging off your current reputation, when you say would acquire C-Mobile as well, you can leverage off a combined brand and invest in that brand as well. So you can use what you know in Africa and take it to other countries when you are investing into C-Mobile. I think it's important as well when you do enter a new market that you make sure that you have the right infrastructure and capital in place so that bad publicity doesn't occur, because if a customer does choose to stay with C-Mobile, it is very easy for them to go to something more trusted as well. So I think it's important that you lay those foundations down when you first go into a new market. And as we suggested, that C-Mobile currently has the license and they're not going to expire that license as well. So that growth, if it's managed well, potentially take market from the leading 4 telecommunication companies and bring it over to C-Mobile with the help of MCOM.
Now what I want to do is hand over to Stephen to tell us about the second team in the semi-finals.
Thank you, Johnny. Next was Team Athena from Zambia. They would make a strong case for 1. Litigate against the government of Nigeria. If guilty, negotiate part and gradual payment. 2. Enter China through joint venture with CloudNet. 3. Proceed with SSC in South Africa. 4. Sell off to Turkish operator and walk away from Iran. And 5. Raise capital by monetizing passive assets whilst liquidating investments. Let's take a look.
We are Athena from the Copperbelt University, Zambia. My names are David Mwanza. Your decision to engage us was a wise one. We have the knowledge, the skill, the intellect to provide you with feasible, sustainable solutions. Now, you've given us a number of issues to look at. This being the fine in Nakolia, the Tunisia bid, the Shared Services Center, and the political uncertainty in Ilanya. Now, we got these issues. We mirrored them against your 7 priorities as a company, and we came up with a ranking of how important they are to you. We will present in this order. Firstly, we'll look at the Nakolia fine, which will be handled by myself. Then we'll look at the political uncertainty in Ilanya, which will be handled by Chanshi. Then we'll go into the Tunisia bid, which will be handled by Shileleko. And last but not the least, we will tackle the Shared Services Center, which will be handled by the lovely Elena Nyala. Let's begin. Firstly, we have the fine in Nakolia. It is clear, looking at Porter's force field analysis, that the restraining forces to increase the fine outweigh the driving forces to reduce it. This is exacerbated by factors such as the public campaign rallies, the bad media coverage, against positive factors such as assistance from Sedimba, which don't have as much impact. Now, on the backdrop of this, you could lose the highest revenue earner in your portfolio, being Nakolia. You could also have other detrimental effects, such as a ripple effect, bad publicity on locations not located in Nakolia. Another detrimental effect of this could be your investments. You need to invest in modern time, and this could be hindered by payments of the fine. From this, we see that it is necessary for you to manage your stakeholders well, some more than others. We recommend a four-step process for this. Firstly, you need to rebuild your reputation. Reputation is crucial, I repeat, crucial for any organization in modern time. Suppliers, customers, investors want to associate themselves with a good brand. Secondly, you need to engage willing stakeholders, people who will help you build on that strategy. The Sadimbaan government has already shown willingness on this part. Thirdly, you need to implement a forum for stakeholder form of CSR. This form of CSR will see you engage the stakeholders, find out what their needs are, and build your strategy around that. More importantly, you need to negotiate for a gradual payment of the fine. A one-off payment of the fine does not do the finances of the company well. Now, on the back of all this, some adjustments need to be made to the financial statements for us to have a clear presentation of the performance and the position of the company. Biggest of which would be the provision in the financial statements. Now, with this provision, it will put the company in a net liability position that is adverse. It is critical issues like this that put the company in a situation that looks insolvent, meaning the auditors will pay particular attention. They'll also look at issues such as the use of the going concern assumption, presentation and disclosure of these issues, and how litigation and claims have been disclosed in the financial statements. Now, the biggest issue that lies in the Nakolia fine is how will it be paid? Let's look at the sources of finance available. Firstly, you've got equity. Now, it is already clear that with the risk that has arisen, the cost of capital will go up, and the share price has gone down due to the market capitalization drop. This is not the best form of finance. There's also debt. Over the years, you've maintained a low gearing ratio. This could be the opportune time to use this source of finance. You could have cash as well. Cash has steadily increased over the years. Some of these savings are coming from the Shared Services Center. This could be an option of finance. But as Athena, we recommend a fourth source of finance, and this is the alternative. You could monetize your passive infrastructure and non-core assets. You could liquidate your investments and loans and use the savings I earlier mentioned from the Shared Services Center. We recommend that you use this source of finance, and in the event that it is inadequate, you go into the bonds market. At this point, we'll go into the next issue, which is the uncertainty in Ilania.
Now, ladies and gentlemen, Greek mythology tells us of a phenomenon known as Pandora's box, which unleashed chaos and uncertainty, a nightmare upon the earth. And we, as Team Athena, feel that this uncertainty for you is your operations in Ilania. It has put you in a position where you do not know exactly what you shall do as an organization. Let's look at the facts on the matter. Standing at 49%, it is your largest investment in the region, remembering, of course, that you entered the area for purposes of further developing into the Middle East. Aside from this, you notice that there is suppression of human rights, first of all. Second of all, there are international sanctions. And last but not least, there is the threat of indigenization. Now, these factors, either individually or aggregated, have the potential to destroy your organization in the area. Let's move on. There are currently 3 strategic options available on the table, and we shall use a scenario-based strategy to basically analyze each and every one of them. Let's remember that each and every one of them has a value, and we shall also look at the fact that your organizational objectives need to be able to support them. The first one, of course, is to consolidate and expand. Aside from that, there's the option to stay the course and to sell off and walk away. Now, let's strip the flesh off the bones. You notice that all these are dependent on the fact that a nuclear inspection has to happen. There's currently a 70% chance of compliance in comparison to a 30% chance of non-compliance. Factoring in the fact that your risk tolerance has reduced, the 30% barely just meets that. There are 80% chance of better outcome, 20% chance of an expected outcome, and a 100% chance in the event of non-compliance of indigenization. This is a risky venture. Now let's get to the nitty-gritties. As far as consolidation and expansion is concerned, in the event of compliance, you stand to net a whopping 245,000 million Sadimbaan dollar. And I shall repeat that again. 245,000 million Sadimbaan dollar, in comparison to less than a tenth of that amount in the event of non-compliance. For the option of staying the course, you notice that factoring in your loans, as well as your dividends receivable, with the potential to sell 5 years down the line, you stand to net around about 50,000 million Sadimbaan dollar, in comparison to only half that amount should non-compliance occur, as a result of the sale, of course. And last but not the least is an option which I in particular seem to love, the option to sell and walk away. 2 options currently are on the table, the option to enter India or to enter Turkey. Now, ladies and gentlemen, we shall use a SAF analysis looking at suitability, acceptability, as well as feasibility to analyze this. You notice that both options seem to meet the acceptability and feasibility. But as far as suitability is concerned, the cash offer to enter India means the money will be deposited in your Iranian accounts. And in the event of non-compliance, gives you a problem in terms of how you're going to get that money out. The Turkish offer is a share swap. This one is an offer which should be considered. The fact that you have a reduced appetite towards risk, have shown commitment to stakeholders, you are a multi-listed organization which is required to comply with corporate governance standings. Hence, the Cadbury report, King report apply. Aside from that, there's the option as well to minimize your earnings volatility. We feel as Athena that Ilania is simply too volatile, and it is not in line with ethical requirements, corporate governance requirements, and other factors. As a result, we recommend that you sell, and walk away. Enter Turkey. At this point, we shall now look at Tunisia.
Now, members of the MCOM board, the Tunisian market is a lucrative market that offers you an opportunity to venture in. But first things first, like any other business, we need to look at the prevailing market conditions. What's currently obtaining on the ground? Tunisia has skilled labor because of the university graduates that are skilled with technology and telecommunications, 182% market penetration rate, and Tunisia is the 4th mobile largest market in the world. However, uncertainty has come about. There's a new government that has brought this uncertainty. Experts have analyzed and they say this is just a ploy to position Tunisia as a business-friendly destination. We don't think so. This is the right time to go into Tunisia. Responding to the prevailing market conditions. Two things are key here. You can either enter the Tunisian market solely as MCOM or acquire CloudNet. The other thing, from history, joint venture arrangements have been successful in Tunisia, but we feel an acquisition of CloudNet is the best way. Why do we think so? Let's take a look at this. Key critical success factors are key for you to have a successful bid. Availability of raising 100% finances and the carbon emission, the track record that has been set of 7%. Cost comparison between acquisition and investment. When you acquire, you will spend 5,255 million Sadiban dollar, whereas if you invest, you spend 4,350 million Sadiban dollar. It is cheaper, yes, to invest, but the risk is better if you acquire because you'll be able to receive more benefits. This brings us to a recommendation. You will fail to raise the finances in Tunisia further because of the track record of 7% that you cannot meet from prior records, which you stand at 8%, acquisition of CloudNet is the best solution. Yes, joint venture arrangements have been successful in the past, but acquisition of CloudNet is the best. Synergistic benefits will be on board. Extra benefits by virtue of harmonization will also be on course. What does this mean? It means, strategically speaking, you will be able to have what is known as a strategic fit. Now, this means a company that is acquired has similar objectives with the acquired company. So this means that you will be able to move forward as a company. The last but not the least thing under Tunisia is that CloudNet has an astonishing 63 million subscriber base. Obviously, with this, MCOM will be able to have a market. From this, we move on to the Shared Services Center.
Ladies and gentlemen, in 2012, you started rationalizing key aspects of MCOM's operational activities using a shared service model located at your headquarters in Sadimba. But before I continue, let's just look at what a shared service model is characterized by. And this is the fact that shared service centers are cost sensitive in terms of their headcount, labor costs, as well as location selection criteria. Owing to this fact, you managed to deliver savings of about 6,600 million Sadimban dollars in the year 2014 through the introduction of a shared service center at your headquarters. A brief breakdown of these savings can be outlined as follows. The total annual cost before the SSC implementation were 14,284.8 million Sadimban dollars. Annual cost recovery by the SSC brought these costs down to 7,685 million Sadimban dollars, delivering huge savings of 6,599.8 million Sadimban dollars. Now, ladies and gentlemen, this is a huge amount. These are huge savings. And on this note, we'd love to commend the board for this cost-saving initiative. But then I'm sure you have questions of how exactly these costs came about, which brings us to the implications of the Shared Service Center decision. First of all, we'll look at currency risk and treasury management. Ladies and gentlemen, MCOM operates in 21 countries, which means that you are exposed to currency risk as a result of fluctuating exchange rates and the nature of your supply chain. However, with the implementation of a shared service center, you're able to abridge this currency risk in that your key operational support activities, which were dealt with in different currencies, will now be dealt with in one currency, being MCOM's operational currency. Next, we have supply chain and information systems. Ladies and gentlemen, we all know that information is a crucial aspect of any successful supply chain. With implementation of the Shared Service Center, information sharing is actually enhanced due to the shared location advantage. Apart from that, there are issues of technology and big data. We know with the implementation, we would have to employ new technology to support this new process. Apart from that, you'd have to know how to deal with your data and manage your data better. But spending on data analytics you can reduce your spending on data analytics through the use of cloud computing, which is one of your product offerings. And according to Infocom Development Authority of Singapore, the global market for cloud computing is actually expected to reach $241 billion US by financial year 2020, just showing the growing future of cloud computing. Apart from that, all these costs are spread out over your different locations due to wider scope, meaning you get to enjoy economies of scale and scope. Which brings us to our recommendation. Ladies and gentlemen, go ahead with the implementation of a shared service center at your headquarters, but bear in mind that implementation will come with its own costs. And apart from that, there are a few ethical considerations that you'd have to look into, which would now go on to look at the ethical side of all these issues, as will be tackled by the next speaker.
Now, ladies and gentlemen, ethics is an issue which cannot be overemphasized. It tears into the very fabric that is humanity. So it is important to recognize the fact that ethics are important. How, you might wonder? By virtue of upholding ethics, you notice that your share price is going to gain, because shares are basically sentimental. As a result, you notice that your returned earnings gain, and hence your business flourishes. Currently, certain ethical scandals, including the one in Nakolia, has already tarnished your reputation. So it's important for you to adhere. Furthermore, you notice that Volkswagen found out the hard way what unethical behavior can do to you. Their sales, their shares have all dwindled. Let's proceed. You find that first up, we have the issue of Tunisia. The world has gone green. So in order to uphold ethical standing, we recommend that you continue partnering with CloudNet, who already comply with ethical requirements in the region. As far as Ilania is concerned, the land simply is not ethical enough, so we recommend that you leave the area and enter Turkey. Next up, we have the issue of the Shared Services Center. As has already been alluded to by the previous speaker, you notice that yes, the shared services is bringing in a lot of money. But in further implementing it, we recommend that you scale down slightly. You sit down and form the sort of board, which is a stakeholder sort of board. Be in contact with other people and discuss basically how you're going to implement it in the lands already not implemented. Last but not the least, we have the offer of Nakolia. Now, your own strategic priorities state that you would like to comply. So, hence, we say you go that way. Aside from this, as a business, you can further go forward by looking at other options and other ventures. We recommend that a relative diversification sort of strategy is concerned. You can partner with already established organizations such as ARM in production of microchips, which will position you in order to capitalize on the Internet of Things option that will come. At this point, my task is simple: to deliver the coup de grace and add the cherry aloft the cake. Let's look at the conclusions. As far as Tunisia is concerned, we recommend that you partner with CloudNet. For the Shared Services Center, implement but scale down on the regions not already done so. As far as Nakolia is concerned, in the event that you are found guilty, monetize your assets to pay off the fine and utilize the savings from the Shared Services Center. Last but not the least, the issue of Ilania. Ladies and gentlemen, as I have already alluded to earlier, Ilania simply is not the sort of area you'd like to trade in. It shall tarnish your reputation, it shall tarnish your goodwill, and you shall suffer by way of shares and returned earnings. On this note, we rest our case.
Thank you very much for the concise presentation. So, as board, you are right. So, we are looking into fix the reputation issues and risks that we have. You mentioned that our shares are really sentimental. On the recommendation that you should suggest on Ilania, sell, walk away, and go to Turkey. What is your think that we are not going to get into the same issues in Turkey with the consideration of the Arab Spring? What are your considerations for moving just from Ilania into Turkey? And also in the same sense, on the reputation point of view, you mentioned that if guilty, negotiate part payment, monetize assets. You mentioned you are suggesting that we will continue the court, or we just stop and negotiate with the government?
So for purposes of answering the questions, I shall tackle the first part involving Ilania. Then I shall hand over to David, who shall tackle the next part in relation to the fine. So as far as proceedings are, in comparison between Ilanya and Turkey, Turkey right now is more stable an environment in comparison to Ilanya, which not only seems to be not complying at the moment, but already has scandals in the past. So looking at the fact that you have reduced appetite and tolerance towards risk, standing at around about 30%, we recommend that you enter Turkey because Turkey has less of a chance of faltering on the same. In relation to the Arab Spring, Turkey is a place which basically upholds ethics. As far as confidentiality is concerned, they uphold the same. I'd like to make reference to the example of the San Bernardino shooting involving Apple in America, where Apple were basically tasked by the FBI to disclose disclose information in relation to the same, who the shooters were. But then Apple opted to take the route of confidentiality to protect the fact that their users respect them and basically partner with them as a result. Now we have noticed similar occurrences happening in Turkey. So as a result, which is why we recommend that you go the way of Turkey and leave Ilanya. I shall now hand over to the next speaker who just give you the recommendations for the next one.
With regard to the court case in Ilanya and the reputation issue, one key factor needs to be looked at, and this is long-term sustainability. The company needs to continue to operate. Nakolia represents our highest revenue earner, which means you need to continue to operate in this market. Key to this is managing your stakeholders, like we mentioned. Now, some of these stakeholders have power and they have influence. And at this point, or the point at which you are, most of the stakeholders are against the company MCOM. So management needs to see you try to engage them, try to reach a compromise, try to get those stakeholders on your side, this being the government, the NTRA itself, and the public. In this case, we recommend that you push back on the court case and try to repair that relationship so that there is a basis of negotiations.
Congrats for the presentation. You presented well the integrated thinking, looking at economics, social and environmental factors. And in your focus on stakeholder management, you focus on external stakeholders. My question will be, how then will you bring in and motivate internal stakeholders to go on with this strategy and achieve the desired result? The second brief question, you did emphasize the issue of monetizing assets to pay the fine. Are there any theoretical foundation to support that judgment? Thank you.
So again, we shall use a similar strategy where I shall tackle the first part and I shall hand over to my teammates to answer the next part. So in relation to handling your stakeholders, as you are well aware of, certain people have already complained in relation to the implementation of the shared services center, that being your employees in other regions, and employees are very much an internal stakeholder, which is why we as Athena Associates are recommending that you as a board, in going forward, implement the shared services center, but you form a stakeholder sort of governance board, which is going to bring in not only yourselves as a board, but then have a second-tier board, which is going to comprise various forms of employees from all around your bases. That way you shall be able to negotiate the best way for you to move forward as an organization. Yes, you will implement shared services also in the other regions, but then you shall be able to simply say, these roles we shall keep in that area, but these roles shall be kept in the shared services center.
And then to deal with the issue of the infrastructure. Now, what is critically being looked at here is the supply chain. How do you deliver value? How do you deliver this service to your customers? Now, what we are recommending is that you cut down on such infrastructure that can be done or outsourced to other companies. This can be buildings or towers that you have, and this can be outsourced to people who can deliver it at a lower cost.
Thanks for a good presentation. Maybe let's just follow up on that, specifically on towers. If you look internationally, where the intention was always to outsource towers, it seems the trend is changing. So your thinking around that. Also, 4.5G is coming, which means it's moving to small cells on 5G, which suddenly towers becomes a critical asset for a telecommunication company. Just share your thinking around that with us, please.
Now, in monetizing our assets, we then lose our towers. But then there's this coming in of 4G. So as a recommendation, it's partnering again with other people who can deliver this service. You can have this service delivered on the supply chain. See how you can get value from that. You can partner with other partners who provide this service at a lower cost.
Just to add on in relation to the same, you notice that in business, basically, there are two sort of strategies. You can either have a competitive strategy or a cooperative strategy. Now, I'd like to make reference to the occurrences of Samsung and Apple and the recently discontinued Samsung S7 Galaxy Note. Now, I feel, or we feel as Athena, that the problem basically is the fact that it is too hyper-competitive an industry. Henceforth, it is important for you at times not always to compete, but to cooperate. Utilize certain distinctive capabilities that other organizations have. That way you can focus on making your operations as lean as possible and better serving your organization and as well as your customers.
Thank you once again. Your presentation was very comprehensive. I just want to clarify on the shared services. You said implement, but scale down. And I can recall you saying keep some of the teams in the other countries. So what exactly are you saying we must do? So we continue with the Shared Services Center in Zanzibar. How do we scale down? Do we close all those other countries? And how do we deal with the backlash? Because already, as you know, everyone is in hams against us in Nakolia. So what exactly are you saying we should do?
Okay, I'll look at the first part, then my colleague will come look at the ethical part of it. So on scaling down, since we're looking at moving things like information technology, human resource to one location, being the shared location in the Sadimba, the headquarters. So there's certain countries that that bring the highest revenue to MCOM, such as Nakolia. So it would make sense to leave some of these activities, such as human resource, in some of those areas. But then for the smaller countries, we can bring all those activities to one shared location. So that's what we mean by scaling down. So it's not moving everything from everywhere, but then other locations will still remain with some of these activities, especially the high revenue producing areas. Yes.
In relation to the ethical aspect of it, you acknowledge with me that you are in business to do business and not only to uphold ethics. So it's important then that you also focus on the financial aspect, but bring a certain balance ethically, which is why we are saying that from an ethical perspective, yes, people will complain, but in terms of the complaints that will come through, the complaints shall be far less than if you did strip them completely of all their jobs, which is why we're saying you keep certain jobs within the region. And what you shall find is not only those people will be happy, but even the government, because by virtue of you keeping the operations in that area, the government shall benefit in form of taxes and whatever other CSR you may perform in the areas.
Now we've heard our second team of the 6. So for this episode, we're going to go over the 3 semi-final teams. So for the last team for this episode, I want to hand over to Tekofatsu to explain to us the 3rd team that entered the semi-finals.
Thank you, Johnny. The 3rd team to present was Team Dolphins from Indonesia. They advised the board, firstly, settle court processes in Nigeria immediately. Second, enter China by acquiring CloudNet. Thirdly, proceed with the Shared Services Center in South Africa. Fourth, sell off and walk away from Iran. And finally, to implement a sale and leaseback operation. Let's take a look.
Good morning, ladies and gentlemen. Good morning, judges. We're the Dolphin team from Prasnya Mulia University, Indonesia. My name is Stephanie. This is Michael, Marcel, and also Sakurisa. In this presentation, we would like to elaborate on MCOM 5 most crucial issues and give recommendation that we believe will give MCOM the best solution in the future and also create shareholder value in the future. MCOM is currently the biggest mobile telecommunication company with over 250 million mobile subscribers. It offers the best business solutions, mobile data services, messaging, and also value-added services. Growing rapidly in sub-Saharan African region, MCOM has a great opportunity to grow since it is predicted that there will be a 12% increase in subscriber number and also 11% increase in market penetration by 2020. But to grab all of this upcoming opportunity, MCOM has to first overcome its business and ethical issue. We have prioritized the issue based on time, financial, reputational, and also long-term impact. And there are 5 things that MCOM needs to do. The first one is to settle the court process in Nakolia as soon as possible. Second is to sell off the business unit in Ilania and just walk out from it. The third is to continue to process the shared service center in Sedimba. The fourth is to sell and lease back the tower and use the money to fund the fine in Nakolia. And the fifth is to acquire CloudNet as the best strategy to enter Chinensia. By doing all of this recommendation, we believe MCOM could achieve its sustainable growth in the future. And after discussing about the prioritization, we will then discuss about the analysis of each issue, give recommendation, action plan, and also talking about the ethical side. Now, let's start with the first issue.
The first and the most important issue is the compliance issue in Nakolia, our biggest market. Unable to fulfill the requirement from NTRA, MCOM was fined for $3.9 billion after negotiation, which negotiation has led to bad publicity, accusing MCOM to support terrorist action. Financially speaking, because of this issue, we see a fall of market capitalization by 25%, and we see a risk of failure to pay, since the fine is 36% of our 2015's turnover. Our reputation has also been impacted. Trust issue from the shareholders, and then we see a bad image that has been formed in the market, which is threatening our strategic positions as market leader in Nakolia. Therefore, an immediate and right action needs to be taken. We do not recommend MCOM to continue this court action because this action will only lead to worsen MCOM's reputation in the eye of the stakeholders, and we see there is only a low chance for fine reduction from the government. Therefore, we recommend MCOM to settle the court action and accept the fine, since this action will regain stakeholders' trust back for MCOM. The first action needs to be taken is to settle the court action, accept the fine, pay the initial payment to the government to show a goodwill, obligate all active users to register their numbers, and help anti-terrorism campaign. Finally, we can pursue a better term of payment, a win-win solution between MCOM and government. By doing this action plan and recommendation, we believe MCOM can regain its reputation in the eye of the stakeholders to be a respectable and trustable company in Nakolia.
Second in prioritization is about the political risk and strategic uncertainty in Ilania. Currently, MCOM holds 49% share of JV Cellular, but unfortunately, it is now in an unstable political situation and being isolated by NNPT for enriching uranium. Consequently, MCOM could not retrieve 4.2 billion Sadimba dollar dividend and 5.8 billion Sadimba dollar loan receivable. MCOM has 3 alternatives to overcome this issue. But we do not recommend MCOM to take the first and the second alternative. This is because of these 3 main reasons. The first reason is because there is a high risk of being nationalized by the regime. And if MCOM is being nationalized by the regime, MCOM will lose everything in Ilania. The second reason is because there is a hyperinflation within the country, and we believe that it could threaten MCOM profitability in the future and also higher translation risk for MCOM investment in the future. The third reason is because it will harm MCOM good global brand reputation because MCOM is investing on a country which is developing WMD. Thus, we believe that the best option for MCOM to take is the third alternative, which is to sell off the business units in Ilania and just walk out from it. It will give MCOM positive of 73 billion Sadimba dollar option value, and if MCOM wants to get into the Middle East market, MCOM could always take the share for share offer from the Turkish mobile share. And if it doesn't work, MCOM can sell this and use the money to fund the fine in Nakolia or even to expand in Chinensia.
The third issue about MCOM proposal in expanding shared service center across the function, which is facing many challenges. Although we have seen a saving of 6.6 billion Sadimba dollars from 2012 to 2014, MCOM's investor is doubtful about the number. Moreover, we see a protest from the market from the dilation of job creation in the market and employees' anxieties. Therefore, for this issue, the question is whether to continue or not continue the expansion of shared service center. Our assessment from the operational point of view, shared service center is very logical to be implemented or even expanded. Because of shared service center, we see a working structure more effective, task delegation simpler, which will lead to economies of scale. And moreover, from financial point of view, we have seen a saving that has been proven by shared service center to make our operational even more agile. Therefore, for this issue, we recommend MCOM to continue the expansion of shared service center across function. Nevertheless, strategic implementation is very crucial to hold public and employees in zeitgeist. We recommend MCOM to implement shared service center step by step, area per area.
The fourth issue in the prioritization is about financial strategy and Nakolia Fund, of course, and of course MCOM capital structure. How should we finance Nakolia Fund amounted 58 billion dollars? Before that, external auditors will come in the next 21 days. Therefore, we should do some financial adjustments and give audit considerations to the external auditors. Some financial adjustments that need to be done are following. First is the recognition of fine amounted 58 billion dollars. The second is the record the quote of tower sale amounted 5 million dollars, and the reclassifications of tower from asset to asset available for sale amounted 20 billion dollars. And the last one is the goodwill impairment amounted 4,800 US dollars. This altogether will result in the worsen of the group income into a loss of 85.5 billion dollars. Moving on to the audit considerations, there are two considerations that needed to be taken into account. The first is going concern, especially in business of Ilania that we're trying to walk out of it. And the second is the materiality in planning and performing audit in multi-location engagements. And now for the funding of fine. There are four alternatives that we can do to fund this fine. The first one is to issue more shares. The second is to borrow money from the bank or issue some bonds. The third one is Turkish Mobile share sale. And the last is to sell and lease back of Tower of Sidams. From terms and times perspective, we can see the quickest and the easiest one to be done is the sale and lease back of towers, because it's already done, so we can retrieve the money immediately. And the second is from the acquiring cost perspective. We can see that it is the cheapest because it will only occur administrative costs. And the last one is from the adequacy of fund. 3 out of 4 options will give the adequate amount to be retrieved and we can pay the fine of Nakolia. Another consideration that we should take into account is that share issuance will strengthen our balance sheet, and it will also minimize our volatility of income. And the second one is that borrowing will weaken our balance sheet, especially the solvability ratio. And it will also help tax reduction due to the increase of interest payment rather than dividend payment. And the last one is sale and leaseback of towers will help decrease tax because of the bigger depreciation expense rather than operating lease expense. Taking into account that all of this is very important, that we need to consider the strategic considerations, which is to minimize our earning volatility. Then we rank and weigh all the ranking, and we come up with the best source of fund for Nakolia fine, which is the sale and leaseback of Tower of Sidams.
The last issue is about expansion to Chinensia, the 4th largest mobile market operator in the world. There will be renewal operating contracts for the biggest 4 operating mobile operators, which take 82% market share in Chinensia, and there will be an auction to get these operating contracts. Our assessment are based on suitability, acceptability, and feasibility assessment. First, from a suitability assessment, we know that Chinensia has 305 million of subscribers who has exceptional demand for internet service. Government also support telecommunication sector with internet access for all program. Government was introduced mobile number portability that enabled customers to keep their mobile phone number even though they change their service provider. This can help MCOM to do market penetration in Chinensia, knowing customer resistance to change their service provider will be very low. Second, the acceptability. From acceptability, we can see that Chinensia has change of political power. Populist party with 72% chance of winning wants to protect national strategic importance from foreign company, such as telecommunication sector. This creates tendency from populist party to favor a local company. And if populist party win, the probability of foreign company winning the bid is only 4%. And third, intense price competition, besides the effect of mobile number portability. Considering the risk and the big opportunity of entering Chinensia, we're considering MCOM to enter Chinensia. But how? There are two different ways to enter Chinensia. First is MCOM Chinensia Limited as subsidiary of MCOM Global, and second by acquiring CloudNet. By using analytical hierarchy process method with three main criteria: cost, probability of acceptance, and profit certainty, we believe that acquiring CloudNet could give more benefit and more valuable and more safer for MCOM. Thus, we recommend MCOM to enter Chinensia by acquiring CloudNet. There is also some ethical issues that cannot be put aside. First, about the legal wrangling in Nakolia. It's about our decision that did not comply with Nakolian's government regulations toward national security, and it makes a very bad reputation for our company. To overcome this issue, there are three actionable steps. First, implement a good principle of corporate governance by evaluating company policy, and second, hold a press conference to fully apologize for unable complying to Nakolian government. And third, inform an obligated unregistered user to register, or else there will be consequence for them. The second ethical issue is about expanding a shared service center, and it caused hundreds of our employees being laid off. To overcome this issue, we have two ways. First is a press conference to communicate why MCOM must implement the shared service center and the benefit of it, both for MCOM and the employee. And the second step is using a lift and shift method, which allows employee to decide whether they want to move to the center or not. If they don't want to move, they will be given time to look for a new job. The third ethical issue is about Ilania consumer privacy. Ilania regime has received several attacks by Arab Spring, and it makes Ilania regime ask out about user personal information as tools and as evidence to track these attacks. Civil Liberty Watchdogs asked MCOM to withdraw from Ilania, and we also recommend MCOM to withdraw from Ilania because it's no longer accordance with integrity to protecting by consumer privacy, and it's also no longer accordance with human rights and privacy rights.
Okay, so ladies and gentlemen and judges, we have finally come to our conclusion. As you can see from the screen here, that there are 5 things that MCOM needs to do to overcome its business issue. The first one is to settle the court process in Nakolia as soon as possible. Second is to sell off the business unit in Ilania and just walk out from it. The third is to continue to process the shared service center in Sedimba. Fourth is to choose to sell and lease back the towers in Sidom and use the money to fund the fine in Nakolia. Fifth is to acquire CloudNet as the best strategy to enter Chinensia. And for the ethical issue, we believe that it is always best for MCOM to have a two-way communication between the people and also the company. And of course, keeps MCOM value and also integrity up by making sure that the consumer data privacy is safe with the company. We believe that it is one of CFO roles to make sure that there will be a shareholder values in the future. And we believe that by doing all of our recommendation, it will bring not only good reputation for MCOM, but also shareholder value in the future. We're Dolphin team. Thank you.
Thanks for the great presentation. In the Nakolian case, you indicated that they should pay the fine. I might have missed something. You did not share how. In the same scenario, do you think it is possible to negotiate a reduction in the fine? If so, what strategy will you employ to achieve that? The second question is, in all the scenarios, I did not hear social, political, legislative, economic risk and how they will be mitigated. Will you share if there are any environmental risk and how will they be mitigated? Thank you.
Thank you very much for the question. If I may rephrase your question, so you were asking how should we pay the fine in Nakolia, and is there any chance to do a reduction of the fine? That was your first question. Thank you very much.
Okay, to answer your first question, how can we pay this fine? So as the fourth case, we already mentioned that we want to pay the fine through we're using the money from the sale and leaseback of the tower Sidoms. We know that the towers the money of the tower sale we will have it next year. So by doing this, we are going to negotiate in terms of payment when we have our cash flow. When that sale happens, we can use that money. But we're not going to pursue another court action because we believe that there's a really low chance of we gonna win another court action because we already get the first reduction. And if we go to another court action, and there is a big chance that we will get an even bigger fine if they find another, for example, another evidence that we are supporting or in another way that we are not supposed to do it. So rather than taking this big risk of getting an even higher amount of fine, we are going to settle down with this and pay it from the sale and leaseback of towers that we're going to get next year according to our cash flows. Thank you.
Thank you very much. And for the second question, may you please repeat that again? We're so sorry.
The question was, firstly, are there any environmental risk and how will they be mitigated?
So risk in the first issue, which is Nakolia. Okay.
Okay. From our point of view, the environmental risk in this case is, if there is any, is really small because the main risk in this issue is MCOM's reputational risk, which is as market leader and as really close relationship with the government, we have to respect the decision that the Nakolia government has made to take care of the national security of Nakolia. So talking about environmental risk, we didn't see any environmental risk regarding this issue. Thank you.
Thank you very much.
Hi, again, thank you very much for the clear presentation. It was really nice to see all your rationale and how you're putting the decisions in place. On the reputation side, on the internal point of view in the shared service center, you mentioned that you would like to go step by step. Yeah. Can you please share a little bit more what is the horizon on what you meant with step by step, and how do you plan to mitigate the potential risk internally on this situation?
Okay, what we mean by step, oh yes, thank you for your question, so sorry. What we mean by step is we are thinking this case as a whole, not only in Sadimba, but also what happened in Nakolia. We know that Nakolia is now facing a really dynamic situation because of the fine and everything. It really impacts how the people look at NCOM. So we want to do this shared service center every country except Nakolia. So after the Nakolia situation has become better, we will then go into Nakolia and continue the shared service center. So we are waiting for the condition to be better.
So you're expecting in the next 12 months or the coming 2 years, or what is the horizon that you're expecting on this?
The horizon of time.
Yeah.
The horizon of the time we are expecting the implementation of shared service center, I think it is finished within the 2 years because we see the unstable political condition in Nakolia and our reputation is in danger. We have to take care of the reputation issue in each market first. Then we can have the shared service center implementation fully implemented across the function. So yeah, basically we want to first take care of our reputation issue first, and then we are expecting not taking this expansion into like priority. I know we realize that there will be opportunity loss if we take a longer time to implement shared service center, but this is like the most logical way we can be thinking about to implement shared service center in terms of we can save the cost and we can save the reputation of the company. Okay, thank you.
Thank you.
Thank you once again for the comprehensive recommendations you've provided to us. I just want to clarify, you advised that we should pay the fine, which has been initially reduced without further negotiations for reduction so that we don't strain relationships. You also said that we will pay it from the sale and leaseback of the towers and that we should sell in Lania and then buy in Turkey. What I'm not sure about is you haven't shown us, will we have enough money to do this? And if we don't, how do we supplement? Because I'm thinking the sale and leaseback of the towers is not going to be enough capital for us to undertake all those recommendations that you've provided.
Thank you very much for the question. My colleague Sakarisa or Marcel will answer your question.
First of all, first we can take money from the sale and leaseback of tower, and after we do that, if we still not enough money, we can get money from saving from the share service center, which take around 4 billion of Sadimba dollar, and it can be for enough money to get payment to the settlement payment to the government of Nicolia.
Thanks for the presentation.
Thank you very much.
Can you just clarify in terms of, and it goes back to the funding that you say that you want to minimize volatility in earnings. How do you align that in terms of overall shareholder growth, as well as taking into account technology that will change? Specifically, when 4G comes in, towers suddenly becomes critical, but you don't have the towers going forward.
By acquiring CloudNet, we know that CloudNet has advanced technology with the computing with the cloud technology, and it will be benefit for us to get new technology for the telecom industry. And for the operating sell and operating leaseback, it's very beneficial for us because when new technology come to the market, we don't need more investment. We just operating lease. So is the technology obsolete, we can change to the new operating license that provide new technology, sir.
Yeah, to add my friend, so actually to minimize earning volatility, we are fully aware that a big investment is needed in future technology, especially in like 4G, even 5G that will come in the future for our telecommunication. To be sustained, we have to keep investing in that particular technology. But what we do to minimize earning volatility, to adjust with the management strategy, is that first we want to our company is in a mess, so we want to calm down first, take care of the sell and leaseback, take care of our reputation, take care of our debt, and then after that we can invest again, and there's a trend thank you.
Okay. Thank you very much.
We have showed you guys, out of the 6 teams, we've presented the 3 teams of the 6 that made the semi-finals in the 2016. Now, as you guys can see by now, this competition has a high standard, a high caliber. You can see from the solutions that these teams they brought to the competition. Now, on the next episode, what are we going to see? We're going to see the next 3 teams. As I told you, been telling you all the time, there were 6 teams that made the semi-finals who entered from all over the world. On the next episode, we're going to do the next 3. Now, by now, you guys, this is the second episode, you have seen the caliber of this competition, and if you guys want to enter this competition, if you want to be involved in this competition, and that could be from a candidate who wants to be part of a team to enter a team, or do you want to be part of this competition as a sponsor? If you want to do that, right underneath here, you'll see our website. You'll see our Facebook page. I encourage you guys to get involved in this competition because it raises the standard of education in South Africa, in Africa, and the rest of the world. This is something that has never been on any world stage ever before in education. Like we said at the beginning, this is the next idols in education in South Africa and Africa. So be part of this competition because it will take you, your team, and your business to a whole new standard. Thank you, guys. I look forward in seeing you on the next episode, episode 3.